Nothing can be ruled out. That was the word from the Bank of England Governor Mark Carney recently as the central bank goes into its final decision on interest rates for 2016. Due at high noon on Thursday the 15th of December, economists seem to be of the opinion that there will be no move on rates themselves after having taken them down to a quarter point in the aftermath of the EU referendum outcome. However, there are other forces in the background. Here's Dr. Shepherdson, Chief Economist from Pantheon Macroeconomics.
Well, nothing in terms of interest rates, but a lot of discussion about the twin forces that they're facing, which currently point in opposite directions. The first problem they've got is that the drop in sterling is pushing up inflation and going to push it up significantly next year, probably more than they think, in my view. Real upside pressure on import prices, and exporters are raising their prices as well in anticipation of being able to build margins. So there's a real danger of this transmitting into the domestic economy. At the same time, though, the domestic economic data, the forward-looking data anyway, the surveys, are weakening. And so there's a real risk that over the course of the next few months the bank is kind of caught between two stools where the economy is sluggish but inflation is rising, and they have to make a judgment about whether that inflation pickup will be transmitted into the labour market and then become a more stubborn problem that they have to deal with through higher interest rates later. But the terms of the debate and the terms of reference for them over the next few months, I think, are pretty clear, and we just have to wait and see how the forces play out.
So those forces looking like that they could conspire to give consumers a rocky ride in 2017. The key trades to come out of the announcement will inevitably be sterling against both the dollar and the euro. Let's take a look first of all against the US dollar. And since that big markdown for sterling in the wake of the EU referendum, we've been trading in two rectangular boxes. The sideways motion here, and you take the height of the box to work out the minimum price objective when you move out of that, and that's exactly what happened. We've got a box here, very similar sort of size in terms of its height, which was marked the bottom. Since then, there's been this bullish divergence. We've got this run up here on this ascending trend line, which has now become the friend to watch. And if we continue to this trend line here, we've got support coming up until we meet resistance at 127.98. If we break out of that, we can then look potentially at the height of the box again to take us up to what was the point at which we entered this back in June at 134.27. I suspect, though, we could well see in the interim some bullish momentum for the US dollar, which may well take sterling down a further leg. But we've yet to get out of this box, and we've yet to get the move. Watch that in the wake of the interest rate announcement at noon on Thursday. Let's look at the second chart, very similar, but in fact here we've in theory got three boxes here. Going into this box here, mark down, a similar sort of mark. We've gone up here, similar sort of mark. So we've got this retracement back again. We're 100% off from where we went into this box up here now at the moment. We do have this rising trend line here, which is now going to become our friend, but we do have this resistance point here at 120, which is sterling against the euro. That's going to be the upside resistance point. Again, this is a trade to watch out of that announcement. The next Bank of England interest rate decision comes in the new year on the 2nd of February, which coincides with the release of the next inflation report.